Hello, good afternoon, everyone, and thank you for joining the webinar this afternoon, or this morning, or this evening, depending on whatever part of the world you are joining the webinar section today. We do appreciate your joining. In a few minutes, we will start fully. I'm just trying to give 1-2 minutes for additional people that are coming on board to join. So thank you very much and welcome. Like I said, this is the 6th series in a series of executive webinars that is being hosted by PML Advisory as part of our contribution to the professional space in Nigeria, as part of our effort to ensure that other professionals get to benefit from our knowledge, from our experience, and we also have opportunity to rub minds as professionals. And today, we'll be looking at IFRS 9 implementation for the microfinance banks, challenges and lessons learned. I've got one of my friends and colleagues, somebody that have a lot of experience when it comes to IFRS implementation generally, in person of Joseph Owolabi, FCCA, joining us on this webinar today. And I hope that we'll greatly benefit from his experience. Just some brief highlight of Joseph, about Joseph. Well, Joseph is a chartered accountant, obviously. He runs a consulting outfit called Rubicola Consulting, focused principally around sustainability reporting and co. And he's also the global vice president for ACCA. Joseph has extensive experience when it comes to the issue of IFRS and professional services. He actually trained at PwC in Nigeria. And then myself and Joseph had to work on an IFRS partner, which is a subsidiary of a Canadian firm called Issue Central. And we assisted a lot of Nigerian entities to convert to IFRS when IFRS was at its peak in 2012, 2013. And I think that was where our path crossed. And since then, we've remained good friends. So doing this webinar today is a great pleasure to bring Joseph in. And Joseph, thank you very much for joining. Well, he's not only joining, Joseph is actually by his local time. Joseph, what's your local time where you are?
Yeah, good afternoon, everybody. It's a pleasure to be here with you, Viola, and everybody. It's just about 1 a.m. on Thursday.
So Joseph is actually on Thursday right now, 1 a.m. Thursday. It is for Joseph. Joseph, I appreciate the fact that you have to keep awake to do this. Thank you so much.
It's my pleasure.
Yeah. So then from IFRS partner, Joseph moved to work in EY, and then from there, EY Nigeria worked in Deloitte Australia. I think I'm correct, Deloitte Australia, and also 1 or 2 of the other major firms before he decided to now run another firm of his. So I mean, we've got a big fish in the room today, and when it comes to Joseph's section, I'm sure we'll appreciate what I'm talking about. So myself, Avila is my name, and I'm the CEO for PML Advisory. I have about 20 years experience now, and I've spent the last 15 years working on IFRS, especially assisting those Nigerian banks that voluntarily adopted IFRS those days in 2007, 2008 to comply with IFRS requirements. and then went to work at IFRS Partner, where we now have extensive experience again doing IFRS, working with several clients in different industries, which was where I met Joseph. Myself and Joseph were colleagues there. And since then, after leaving there, went to co-found PML Advisory. I will focus a lot on IFRS. I'll tell you in terms of IFRS today, I've been privileged to have done maybe over 100 projects, excluding the several trainings that have been given to different kind of people. So today, we're focused on microfinance bank. I want to just, in 1 hour, 15 minutes, just talk around some of the issue challenges from IFRS 9 implementation and some of the things that have happened, because in the course of preparing this, we now saw there was even a CBN circular discussing the issue of IFRS. So, I mean, we'll have opportunity to do that. Please feel free, the chat box is there if you want to pass a comment or you want to send a question in. Also, in the course of the presentation at the appropriate point, we'll take question and answers. People will have opportunity to ask questions, to share their view and co. So welcome. So in terms of backgrounds, just to provide background to some of us, IFRS is International Financial Reporting Standard and is a global accounting standard that Nigeria became or adopted in 2012. So in 2012, Nigeria adopted IFRS, and in adopting the IFRS, we had a roadmap that grouped Nigerian entities into 3 buckets: the public interest entities, the other public interest entities, and the small and medium entities. For the public interest entities, which are entities that are regulated and file returns with a regulatory authority apart from tax returns and CAC returns, which are mandatory. Those are considered as public interest entities, whereas we have small and medium-sized entities, which are companies that are considered to be small, and it has very strict conditions defined in terms of total assets of more than 500 million, total revenue, no foreigner in the books. I mean, as part of the directors, more than 51% of the shares of the companies are held by directors. Those are considered as small and medium enterprise. And then we'll have other public interest entities, which are typically those that do not fall into group 1 or group 3. But when we talk about IFRS, I mean, IFRS itself is made up of those 4 items: the International Accounting Standard, the IFRS itself, the IFRS, the SIC. That's what makes up IFRS. And so every time we talk about we adopting IFRS, we are talking about adopting the totality of the 4 pillars. So for the various entities, they've all migrated to IFRS in accordance to these states. But then in 2012, because of the challenges and peculiarity of IFRS and the size of most of the microfinance bank, even while they fell into wave 1, wave 2, CBN gave us a waiver. And a lot of us, a lot of the MFBs did not even adopt IFRS 10. But it is interesting that of recent, maybe last week, we saw the circular from CBN. When we're putting this together, we're not even aware that CBN was working on something. We just put this together as part of our usual webinar series as a firm. So it looks like it was preempted, but it's just timely. So would a lot of us, the microfinance bank, the question is, how far have we gone with our IFRS adoption? Not even IFRS 9 again, even the IFRS, because CBN is asking the question around IFRS. But let's talk about IFRS 9 itself. IFRS 9 is a standard that's focused on financial instruments. And when we're talking about financial instruments, we're talking about things like accounting for your treasury bills, your bonds, your loans, your advances, which, if you think about it, is essentially what our operation is about as a microfinance bank. We essentially deal with loans, with investments, with deposits. All of those things are considered as financial instruments, and the standard that deals with it under IFRS is IFRS 9. And the standard became effective 1st January 2018. This was our concern because we saw that a lot of even MFBs have not adopted this standard, even while it's effective, despite the fact that we've seen circulars that were issued by CBN on the adoption, or knowing that there was even a major one, which is the IFRS itself. But the standard covers the whole recognition, measurements, and disclosure, impairment and disclosure for financial instruments. And it came to replace IAS 39. This standard replaced IAS 39. It's actually a replacement for our favorite IAS 39. Well, somebody is already asking questions about the material. Don't worry, the videos link will be available. The PDF also will make it available for you. So IFRS 9 replaced IAS 39. And in terms of focus, there are three principal areas, changes that IFRS 9 has introduced, which are classification and measurement of your financial instrument, how you classify and measure the financial instrument, the impairment, how you calculate impairment under IFRS 9, which is not different from what it was under IAS 39. Then edge accounting, which possibly a lot of us will not in this room will not be applicable to us. But CBN is asking questions also for people to demonstrate compliance and show that they've adopted IFRS 9. But that has now even extended to IFRS itself for MFBs. So if you look at the all expected changes, recognition of financial assets or liability, which is that is essentially in line with what we had under IAS 39, which is you recognize financial assets or liability when once the entity becomes a party to the contractual provision, until you becomes a party to the contractual provision, you will not recognize your financial assets or liability. That's what it was under IAS 39, not so much a change. Let's look at classification and measurement. IFRS 9 again retains the classification that we had under IAS 39. It basically retained the classification we had under IAS 39. But the measurement, it was has changed. Sorry, I said no. Apology. IFRS 9 retains the recognition principle that we have under IAS 39. But in terms of classification, the classification and measurement have changed under IFRS 9. And essentially, there are two things that are very important when we want to classify our financial instrument under IFRS 9. And that's whether the cash you are getting for your investment from this financial instrument is sole payment of principal and interest, the cash repayment that they are giving you or the cash return you are getting, is it for the purpose of payment of principal and interest only, or there are other benefits? Maybe the cash flow you are getting also incorporates an element of changes in fair value. Maybe it's not only that they will repay your principal or your interest. If the market value has changed, you also get some extra benefits. That's one factor to consider when you want to classify and measure your financial assets. Then the business model. What is your business model? What is your business objective? Are you the type that when you buy this instrument, your intention is that you will get your instrument repaid back via collection of principal and interest only? Or you are the type that you have in mind that somewhere down the line, you will take advantage of the fair value in the market? That's business model. Depending on the answer to those two questions, that will determine the classification of financial assets and the subsequent measurement. So when we want to classify financial assets under IFRS 9, we'll talk about financial assets at amortized costs, fair value through other comprehensive income, or fair value through profit or loss. And when we talk about financial assets at amortized costs, we are talking about financial assets that the main objective of making that investment is for you to realize your investment via repayment of the principal and interest. And you essentially do not have mind of taking advantage of fair value or changes in the valuation of the instrument. You want to realize your value back via the payment of principal and interest. And that is also your business model. That is what you do. Not that you will change your mind in the course of the life of the instrument. Then we have fair value through profit or loss, which are those that you expect that you're going to take advantage of the fair value, of the changes in fair value. In fact, your intention is to trade on those instruments. As you think the fair value changes, you want to realize the opportunities that have been created by the change in the fair value of that instrument. And then we have fair value through other comprehensive income, which are also instruments which are typically unquoted instruments in nature that you realize the value occasionally through the changes in fair value of such instruments. This analysis have a very long decision-making tree that we use to make this kind of complex classification for institutions. But because of time and simplicity, we've just decided to make it very straightforward and simple. But it can be much more complex than just the brief explanation that I've given. Then you have your financial liability, which is measured at fair value through profit or loss, or at amortized cost. You can also classify your financial liability through any of those two buckets. Then impairments, which is a major one, even for MFBs. Under IFRS 9, impairment is based on expected credit loss approach. And this essentially is saying, even when you grant a loan to a customer, before the customer will default, you need to recognize the loss you are expected to incur in respect of that loan from the word go. You know, that's slightly different from what we do. We wait until the customer default and then we recognize impairment. But under expected loss model, you preempt the fact that the customer will default. We all know that when we give loan, default risk is never zero. We know that if we give loan to 100 people, we must see 1 or 2 of them that will default. So what IFRS 9 wants us to do is that from the word go, we should recognize the expected loss in respect of the loan, in respect of our financial asset, even while financial asset is still performing and meeting all the obligation. This impairment can be either a 12-month expected credit loss or a lifetime expected credit loss. And I will talk briefly about the two. What's the difference between the 12-month ECL and lifetime ECL? So when we talk about IFRS 9, you know, I've talked about the amortized cost. There's some instrument at amortized cost. And when we're talking about amortized cost, essentially is amortizing the total cost of that loan, the total returns of that loan over the life of the loan. Amortizing the total return of that loan over the life of the loan using a compounding basis. How does this come out? So you look at us as MFBs, most of our fee are just form of returns we earn from those customers. And we typically recognize them immediately. We grant the loan to the customers. With IFRS 9, even with IAS 39, such fees supposed to be an integral part of the income, and it's supposed to be amortized over the life of that loan, so that you can effectively amortize the yield, the returns you are getting from that loan over the life of the loan. So that's what amortized cost concept is all about. So in terms of the impairment, like I mentioned, so impairment under IFRS 9 is strictly expected credit loss, and all financial instruments are classified into 3 stages, depending on what has happened. Stage 1 is typically when there has not been any significant increase in credit risk. So for this classification, the main consideration is significant increase in credit risk. So between when you gave the customers the loan and when you are reporting, based on your assessments, has there been any increase in the credit risk of that customer? From your credit assessment of the customer, has his risk profile changed? If his risk profile has not changed, it is still the same risk profiling, it will remain in stage 1. If it has increased, you are not saying, oh, the customer risk has increased because of whatever reason, maybe maybe you hear that the factory got burned, maybe you hear that the sector is now in trouble, maybe you hear that the customer has lost his job, then it can move to stage 2 or stage 3. So the driver of the stages the instrument will be classified as is whether there have been significant increase in the credit risk of that financial instrument. And at the initial point, when you just gave that out, is considered as low credit and there have not been any increase, you will keep the loan in stage 1. And for it to remain in stage 1, it also means that there must not be any obligation due that is more than 30 days. That's the minimum that you can, the maximum you can have as required by IFRS 9. Immediately it's more than 30 days, then it can no longer be in stage 1. And at that point, you will recognize 12-month expected losses. And what we mean by that 12-month expected is that you are estimating to say within the next 12 months, this is what we're expected to lose because it's still in stage 1 when there is no past due obligation that is more than 30 days and it's still considered as a low credit risk or there has not been any significant increase in the credit risk. Then stage 2 is when you say it's underperforming. Now there is an increase in the credit risk based on our credit assessment, and the obligation due is now more than 30 days past due. It has passed 30 days past due, but it's not up to 90. Then you consider it as 12 months. You consider it as underperforming, and you recognize lifetime expected losses at that point. Lifetime expected losses, which means you are estimating and say, now, it's underperforming, it's no longer meeting its obligation. This is how much we expect to lose over the life of this loan if it remains here. Then stage 3 is when the customer is no longer performing. The instrument is now in default. It has failed to perform its obligation. At that point, you need to also recognize lifetime expected losses for non-performing loan or for non-performing assets. And when we talk about lifetime expected losses for non-performing assets, the way we estimate it is slightly different because at that point, you are asking yourself, how much can I still realize? How much can I still get in respect of this instrument? And that is what you will need to discount to determine the recoverable value and what you can recognize in your books. So in terms of just to give some of us some heads up around the formula, so you find that our 12-month expected credit loss is determined typically using exposure, which is the amount in your books, times probability of default, which has to be the 12-month probability of default, times your loss given default. For those of us that will come from risk management background, you begin to see that this terminology has a correlation with risk management. In fact, IFRS 9 is built a lot on risk management framework and risk management models because probability of default are risk management language, loss given default are risk management language. But we're expected to have models to capture this and use that in building our models that we'll use in estimating the impairment. So we'll use a probability of default of 12 months and a loss given default for 12 months. For the lifetime expected credit loss, it's a similar formula, but the only difference is that the probability of default is not a lifetime probability of default. The probability of default that the customer will default over his life of the tenure of the loan, over his lifetime, whereas the first one is probability of default over a 12-month cycle. So that's the first difference between the 12-month and the lifetime expected credit loss. But this is for lifetime expected credit loss for underperforming. So let me just quickly run us through some of. So when we talk about probability of default, we're talking about the probability that the borrower or the counterparty may default. What is the likelihood that the customer will not pay its obligation? And that means that as an organization, as an MFB, we must have a way to track that information over a period of time so that we can make the estimation. In terms of how these estimations are made, you can use things like your historical customer data. If you are the type that you've been keeping record of your customer data from time to time, over a period of time, you have an idea of how your customers have been behaving, their performance, their default record, you have maintained it over a period of time, and then you can use that data to build the historical loss model. I mean, the probability of default for such customer. You can also benchmark against external rating agencies. There are some data also in the market that you can benchmark again to say, okay, based on this category of customer, this is the expected probability of default. We can do some leveraging to use that external rating agencies to benchmark what probability of default will be for our portfolio. Or we can do a combination of the two. A combination of the two, meaning that you combine the 1 and 2, maybe average it and use that to estimate what your probability of default will be. I mean, it's a lot of data work. I must be sincere with us. It's a lot of analytics that needs to go into that. And when that is done, one other thing that is also very important that is peculiar to IFRS 9 is the economic forecast. It's not just to calculate it using your historic data. We need to do some economic forecast, meaning that, yes, we know what our probability of default was for year 2020, for example, but we know that based on the economy of year 2021, it's not likely to be the same thing. We cannot use the historical probability of default of last year for this year because the economic variables are not the same. So part of what we are expected to be able to model is to correlate those macroeconomic variables with your probability of default and use it to simulate what the probability of default will be for a future year. Looking at the macroeconomic projections and saying, based on this macroeconomic projection, this is what the probability of default will be for the future year. And I mean, we need to be able to create multiple scenarios when we want to do that, so that our projection is not just biased. So we need multiple scenarios, but the economic variables needs to be incorporated. For loss given default is just a measure of how much you will lose when a customer default. It's a percentage estimation that tells you that when a customer default, this is the proportion you are likely to lose. And that you are also allowed to consider collateral in determining it. So what are you expected to do? You expect to go to your loss data record, what has been the experience with your customers over a period of time, 4 or 5 years, and say, okay, from my experience, this is what we lose when our customer default, when the customer fails to meet up his obligation at any point. This is what we are expected to use. So the data will help us to be able to make that projection. I'll be honest with you, I know a lot of us will be wondering and saying, are we back into statistics class? Well, it's a lot of statistical work. If it's a long training where we have time, we even remind us, some of those things we learn in statistics class, independent variable, mutually exclusive event, all of those kind of things, so that you can be able to maneuver the data and analyze it. So we look at that to determine the loss given default, and these are possible scenarios. Basel II, using a foundation approved Basel II recommended rates, some regulators set LGD for loss given default. We can also benchmark with external rating agencies. We can use some internal based models using our own internal data. And I will tell you, you need your internal data as much as possible so that what you are using is not external bias. You don't want the data that somebody have just worked on in the US and generated for the market. You want the data that is also have some element of your business when modeling your LGD. So that, then we'll move to the next one, the expected credit loss for the non-performing. So for your non-performing, immediately you consider that, okay, this loan is now, or this instrument is now non-performing. What we expect to do is estimate the expected future cash flow. And that's estimate the expected future cash flow. I'll be honest with you. There are a couple of ways that people go about it to estimate it, from sitting down to the customer to analyzing their data over a period of time. At the end of the day, you will make an estimation of what you think the cash flow you can get from that customer will be. And that has to be discounted. That's why we have the PV of the estimated future cash flow. That future cash flow has to be discounted to this recoverable amount. You need to discount the expected future cash flow to arrive at what will be the recoverable amount. And it is that recoverable amount that you deduct from your kind amount. The kind amount is the amount in your books to be able to determine how much impairment you need to recognize in respect of that instrument. So a lot of data work involved. So one of the things, and for some of us that possibly you have implemented even IAS 39 or you have implemented IFRS 9, one of the things that is very important is back testing of your model. Because I know some of us will be wondering, this is a lot of also subjectivity. So the back testing of the model helps to remove subjectivity. What do we mean by back testing? So this year I forecasted that my probability of default is 5%. For year, let's say in 2019, I forecasted the probability of default of 5% for Nigeria. For my portfolio. This is 2021. I can evaluate what was the actual probability of default for that year 2020. And then statistically consider, was my estimation accurate? How fair was my estimation in year 2019 for the year 2020? How accurate was it when I compare the actual of my year 2020 with what I projected in year 2019? Depending on how close it is, I might need to recalibrate my model again. And that is how models are standardized. So if we are recalibrating it year on year, checking what you projected in previous year and what was the actual, what you see is that after a period of 5 years, your model becomes standardized with very minimal variance between your projected and the actual. And that is really what is recommended, that you do a modeling for a period of 5 years so that you have enough data to test your model and be sure that your model and assumptions are accurate and they represent the credit behavior of the portfolio that you have. So back testing is very important. It's not just for us to make the assumptions, but those of us that have adopted IFRS 9 or you are even doing IAS 39, there's need to back test it from time to time to be sure that it's fine. So what do we see as challenges? We have been opportune to have done IFRS 9 for some of the MFBs, even IAS 39. I see the first challenge you need to start thinking about as we listen to this webinar and we will go away from this webinar is that how do you determine that there is a significant increase in your credit risk as an organization? How do you determine that there is a significant increase in the customer's risk? Really speaking, the way it's supposed to work is that you're supposed to have a model that you use for the credit assessment of your customers. And from time to time, maybe on a quarterly basis, you will do a credit assessment and confirm what is the credit risk of that customer. And if there is any increase, then you know that there is a significant increase. But I know that a lot of MFBs will have challenges with this. So when we do this kind of work, you need to be able to incorporate some of your CBN classification in determining whether there has been an increase in credit risk so that we can model it. And the same thing, the staging and transfer criteria, because it needs to be able to move from stage 1 to stage 2 to stage 3. So we typically, because of data constraint, do an hybrid between CBN classification and this, and use that to model it. Estimating the loss parameters is a lot of work. Probability of default, loss given default. There's need to put in the data, do some calculation, do some analysis, and that will help us in determining the probability of default, the loss given default, and also do some back testing. The same way it is estimating future cash flow. We need to estimate the future cash flow for those ones that are in category stage 3. Back testing, there's need to check our model and be sure that it's accurate and is correct. The software, let me emphasize this a bit. IFRS is not 100% software, but it's also but the software is also a very important aspect of IFRS. As much as possible, we need to align our technology to deliver some of these things for us. Some of us have a manual we will do our credit assessment, but it's not in our software. For you to effectively implement IFRS 9, there's need to have your credit system on your software so that whatever data is generated is maintained in that software. You don't need to be looking for the software from time to time. I mean, you're looking for the data in hard copy file, because that would be wasting our time. That would be wasting our time. A lot of manpower may be going to that. So you need to have the software that is able to do that. If your software vendor is also very knowledgeable and we can put in some knowledge into him, it can also even build this probability of default for us, the loss given data, because it's the same data from the software that is used in modeling needs. So you can put that in. And then even our chart of account, trial balance, we need to align the classification with IFRS 9 or IFRS generally, so that whatever is produced from our trial balance is IFRS and IFRS 9 compliant. So there is need to work on our software to align with the IFRS requirement. But beyond also working on the software is that there is also need for the accountant, the risk management team to be knowledgeable in all of this, so that we can implement it correctly. And I mean, I expect that most of us on this webinar from MFBs have seen this circular, and this was sent in October 8th by CBN, reminding us to comply with IFRS. Like I mentioned at the beginning, even while we didn't know that this was going to happen from CBN when we started putting together this event, but this is here now, and it means that some of us have not complied with IFRS itself. And I'm aware, because I've received, as a result of this, we have received 1 or 2 calls from people asking around, please, how can you support us? How can you help us to comply with IFRS 9? I mean, with IFRS itself. So we've thought through this, and we're also doing some things to support this industry. And I'll tell you, we're putting something together that we think will be cost effective and is going to help the industry. I will share what we're putting together. Maybe before Joseph comes to take over this, let me just show us and share what we are putting together for the industry. So when I'm through with that, then Joseph will have his own section, and it will be essentially, Joseph will talk to us around also his experience assisting Nigerian companies, and also experience assisting companies globally with IFRS adoption and IFRS 9. What has been his experience out there in Europe? What has happened? What are people doing? So this circular has come to stay and is out there, and we are launching something. I don't know how many of you have not adopted IFRS as an MFB. I think also at this point, I will launch an opinion pool. I think it's good. We have a small pool. We want you to help us complete, while this is still going on. Please help us complete those 3 questions. Well, there is we have a reward for everybody that complete it. You also have opportunity to get some of our IFRS materials, including this presentation and our IFRS 9 handbook. We have a book that explains IFRS 9, specifically tailored towards MFB. I think that will be given out to as many people that have also take part in this. The pool. For you to have those books, you must have completed the pool. So we know that you also giving us some measure of feedback, But so I don't know how many of us have adopted IFRS or not, but we have created something that will help you to adopt IFRS and also comply with IFRS 9. And we have tagged it IFRS Quick for MFBs. When we saw the opportunity and we begin to receive call, we said we need to help this industry. So it's a virtual IFRS conversion services, group virtual IFRS conversion services that we are using to assist MFBs. We already have 1 or 2 people on that have already signed up, and in a few days they should start. And I'll tell you, one of the things we did when Nigeria was initially adopting the IFRS was doing what we call group conversion. The firm I worked for then, we used to do group conversion program where we bring several people into room and we'll assist them in adopting IFRS. We'll assist them in complying with IFRS. And from there, a lot of insurance industry, if you don't put in insurance industry, you can always ask them about the group conversion project. It cut down the cost of the project by more than 50% for some of these insurance companies then, because you are able to work together as a team without compromising your confidentiality of your data of your business. So we are launching this for the MFBs in Nigeria, and this will essentially is completely deliver virtually plus a day visit to your site. Our consultant comes in to just check and be sure that everything is fine, everything is in order for your business, and you successfully comply with IFRS. So for as many of us that have not complied with IFRS and you are still looking for somebody to assist you, please, we are here. We can support you. In terms of experience, we have a lot of experience in that space. Like you said, as a firm, not all our previous experience working in the big firms, but even as a firm, we have done more than 80 IFRS projects and trained more than 200 people. 15 years we have been doing this, and we've assisted some of the big MFBs who, they even wanted to work alone. They converted the loan to comply with IFRS. So we have a lot of resources, materials that can make the journey very easy for you. And things that we'll be delivering to you include IFRS training, virtual IFRS training. We will assist you with doing all the necessary planning and project planning, putting together the training and gap analysis that we know CBN will require of you to show that you've complied. If you read the circular, you say they want to be sure that you've actually complied, you've adopted IFRS 1 properly. If you want to check whether you've complied, because some of us may even say, have we not complied? The question is that, have you at any point in the life of your business adopted IFRS 1? Have you made any explicit statement that you've complied with IFRS? If you've not done those two things, you need to comply afresh. And I'm sure CBN is guessing people that have not complied. They've seen a lot of financial statements that are not in compliance with IFRS. And that must have been the basis of them issuing this circular that we need to comply. So we will also support you in preparing the financial statement. In terms of the deliverable, you can see the deliverable up there, the project plan, the accounting policies, the risk management framework, gap analysis, IFRS 1 election and disclosures, your financial statement. But we are also adding one very good thing to you, and that is our IFRS reporting tool. So we have a tool that assists our client to prepare IFRS statements with. We set up the tools, and that takes up the burden of them preparing the financial statement from them. That helps us in cutting down the time that is required to complete your IFRS project. So for as many people that are signing up on this, we will be giving you that to access for 6 months at no extra cost to you. That will be given to you as part of this project. We want to see that you get your project completed in a cost-effective manner and on time. The year end is just some days away. It's just some days away. December is just some days away, and you need to demonstrate to CBN that you've complied. And like the slogan I always tell people those days, even when IFRS was at peak, is that please, if you don't want to be told, you don't want a broken down IFRS project in the middle of it, we are the guys to talk to, because we know how many people, when we're doing 2012, 2013, that had failed IFRS project and will have to go and support to get their IFRS completed. So please, you can reach out to us in that regard. I will shortly transfer to Joseph, but before then, I can see one or two questions. Let me just quickly deal with this. Nice presentation. I hope to receive the PPR. Yes, sure. Sir, the question in respect of definition of small and medium enterprise, according to IFRS, do you think this definition has changed in respect of New Finance Act? Well, I know what that's from Jacob. I mean, I understand the conflict between the Finance Act and the FRC Act, the FRC definition. Well, for reporting purpose, we need to stick to FRC, because FRC is the custodian of reporting. For tax purpose, you need to stick to Finance Act, because FRS, IRS are the custodian of tax law. Hope I've answered you. Do you have an IFRS MFB conversion package for those specifically without robust software? I think I've answered this now. Sir, hope we are getting the slide. Yes, we are getting the slide. Are we going to get the recording link? Yes. Okay, I think I've answered all the questions. I saw an hand up. Somebody's hand was up in between. Okay, I think he has dropped his hand. So, I mean, that's quickly from my end. I will allow Joseph to share some experience with us, and then take questions if you still have more questions. Hello, Joseph.
Hi, Avila. Can you hear me?
Yeah, good to see you again, man. You know, I'm sure you still remember our troubles of those days. I would disrupt the market with the group package. I'm sure you'll be laughing your mind that, okay, here comes another group thing.
Yeah. No, thanks, Viola. And I see we've got over 80 people on the call, so it's exciting to see. And I'm also listening to you present, and it was a refresher. I think you've also given all of us a refresher IFRS 9 course there. So thank you. But good afternoon to everybody. I'll just be sharing a bit of my experience, and thanks, Viola, for at least giving some context to what I've done in IFRS. And so I've been opportune to help a number of the banks, non-banking entities, manufacturing, oil and gas, Nigeria, but also in Australia here. But more importantly, to see them, after many years of reporting on IFRS, still continue to evolve and face challenges. So one thing I would like to tell all of the microfinance bank players here in the room is it's not even just your conversion. There will also be challenges going forward because as you know already, the standards keep changing. And because of what you would have seen, there's a lot of talk on climate change and all of that. We expect that to also have an impact on reporting as we go forward. So I just want to focus on key things that will help you on your journey. And Biola's helped us all by setting that context in terms of the unique approach. I think the first thing for me is getting a trusted advisor, someone that can hold you by the hand and help you through your IFRS journey. So for entities in Nigeria that has gone ahead, for some of the banks, like we mentioned, for some of the PIs, the public interest entities that have converted in the early 2010, say 2011, 12, and what have you. What we saw there was that for those that worked with firms that knew what they were doing, it was easier because remember, you still have your normal business, right? So your microfinance bank, you still need to chase risk assets, get money from surplus, provide it to your retail customers and what have you. And so that's your main business, managing that business, ensuring that your processes are efficient, ensuring that your technology is working well, that you can scale your business. That's your core business, right? And also your risk management, ensuring that you've got the appropriate risk management process in-house to help you drive growth and prevent risk from crystallizing. However, this is a distraction that you need to meet. You've seen the circular from the CBN. So to make it easy for your team, it's usually helpful to have a trusted advisor. And I'm sure PML, with that huge experience, and Biola leading that team with so vast experience working with entities in Nigeria, can be that trusted advisor for you. So number one is trusted advisor. Number two, I feel also is that most people don't understand the challenge, especially if you are, a bank or microfinance bank or other non-bank financial services operators. It's just huge. The data requirement. We've talked about the probability of default. We've talked about the exposure, default, and also looking at some of those critical data points that you need. So think about your loss for the first 12 months, which you need to come up with. The credit impact of that, as well as also moving from not just an incurred loss model or expected loss model, or incurred to expected loss model. So now you're not just looking at what has happened, but you have to look at future, forward thinking. What could happen? What could go wrong? And that's what IFRS 9 is doing. You also need to think about some of the macro economic data you need to think about, just, employment issues, GDP criteria, other macroeconomic indices that might not be readily available. So there's always the challenge from data. And believe you me, you've not done this before. You've not gathered this data before. So it's going to be daunting, right? So that's why it's also good to have experience from people that have worked on this before to guide you to unpack the difficulties that you will find in even understanding the technicalities of the standard. I think another thing that will be helpful also is setting the right systems. So you find that IFRS is not just getting your financial statement, you need policies and all of that. What I find, especially coming to Australia, is that if you've had a rocky start, so for entities that have been reporting IFRS over the years, if you didn't do your conversion project well, you carry over that challenge. And you find that over the years, you still have to suffer, sometimes fine from regulators because there are errors. So when you have errors, don't forget, these errors might have impacts on you, ISH, right? So you might have to go back and retrospectively adjust your financial statement. And it's not good for you. It's not good for the units, the finance function. It's not good for you if you are the CEO, explaining to the owners of the business or your investors, as it were. So, propensity for errors and fines are huge if you don't get the foundation right. So also having a team, project manage the whole. So this is like a program change. And so it's usually good to have like a small team that would help you drive this. And I love the fact that the unique approach, PML, it's not a novel approach. It's not totally new. It's been tested and proven. Getting players in the same sector together, you can rub minds with other microfinance banks. I'll be going on that journey with you. You get to meet your contemporaries from other microfinance banks, and you can share resources, share insights. I think that's very, very useful because you find that you're going through, similar challenges. Your client base is, similar. Sometimes your portfolio, they're also similar. So you find that you can share a lot of thought leadership there. So, I'll leave it there. I don't want to bore you with that, but I think just to recap, you need a trusted advisor. It's very critical. Don't underestimate, the challenges you could find with data. Even in advanced economies like Australia and the US and the UK, data is still a challenge. And so especially in developing economies like Nigeria, you discover that the data is not there. Sometimes you have to create your own data and how to make that acceptable to regulators like CBN and also to your investors. And thinking about also, not having a rocky start to it, because you want to be able to have a sustainable reporting process to prevent fines and also regulatory sanctions in the future and retrospective adjustment of financial statement, which may come from errors that you carry forward. And the last but not the least is getting the right team also within your organization, having that project management, and also signing up to a program like this that takes you as a sector or a subsector, carries you on that journey and ensures success. So I think that's all from me. Hopefully I've been able to share one or two things there. Thank you.
Thank you very much, Joseph. That was very insightful. Thank you. I appreciate it. Okay, so we've got one or two questions, and I will also allow one or two people, if you have questions you want to ask, you need to raise your hand. But then let me read some of the questions that are in the chat box. So if you have questions you want to ask, raise your hand. But question in the chat box. So, sir, how can a loan of less than 12-month tenure be classified under 12-month bucket? So, for the ECL model, you are expected to classify your instrument under 12 months because the tenure is less than 12 months, and you're saying that it's still a low risk, or there has not been any significant increase in the credit score of that customer since it was granted. So that it has to be in the 12-month ECL bucket. The conversation that people typically then have is around, so should the ECL be for 12 months since the tenure is less than 12 months, or should we have an ECL for a 1 month or 2 months or 3 months? The standard expectation is 12 months. And you see that also in practice, even to get 12 months ECL out, the period is so short that you don't even find the data. Talk less of cyclical quarterly ECL. Some people have ECL model for advanced economy that are built for a shorter period, but a standard thing you see around here, because of the availability of data, is a 12-month ECL. They even apply for loans that typically have tenure of less than 12 months. Again, when assessing lifetime, are we considering the loan tenure that, again, when assessing lifetime ECL, are we considering the loan tenure or that we are considering the credit as perpetuity? So we are considering the credit over the lifetime of that loan. How long you expect the loan to be? 12 months, no, maybe not 12 months. You are considering as the tenure of the loan and when you expect that the cost of the loan will be finally either written off, wind down, or you close every subject on that loan and move forward. So you are raising it over the lifetime. How long the loan will be around before you move on from it. You either write it off or say, okay, we take our loss and move on. Okay, two hands are up. Let me look at the two hands. Okay. Okay. So this hand, I will allow. I have one of our former colleagues. Our former colleague, this is Chris Okele, joining the call. Maybe I will just give Chris opportunity to say hi. Chris was the business manager those days when we used to do group conversion, and he was one that disrupted the market, led the marketing efforts. So let me just allow him to say hi while before reading the other question.
Thank you, Biola. I don't know if you can hear me.
I can hear you.
Thank you, Biola. Thank you, Joseph, for the insightful training you've just given. I remember back in 2011 when we did the group program, there seems to be some differences here. And I can just see the audience that two of Nigeria's best hands in IFRS have been talking to you for the past couple of minutes leading to 1 hour. I have gotten myself updated. I'm not an accountant, but these two gentlemen, by virtue of the trainings we had those days, make me speak like an accountant each time we stood before an audience. So I'm really glad to be here, and it's nice connecting with you guys again. Thank you, Joseph and Biola.
Thank you, Joseph.
Thanks, Chris.
Chris, nice to hear your voice again. Okay, the next question, Joseph, I think this question is for you, specifically directed at you. Can you please open the chat box? The last one said, Joseph, please, what do you think of MF? Yes.
Chris, what do you think of MFBs that gave out loans and these loans becomes non-recoverable due to COVID-19 pandemic? The borrowers were not able to pay back, and this was not classified as ECL before COVID-19, as entities have not experienced such before. Okay, that's an interesting one. So, again, depends on where you are in your journey. So if you're thinking about IFRS, if you're already, let's assume you're not reporting IFRS before. If you're not, I'll give a response for that. And if you are, so if you're reporting IFRS already, then remember how Biola talked about stage 1, stage 2, stage 3. So from what you're describing, if you're saying they will not be able to pay, it looks like it's a stage 3. Then you need to assess that within that portfolio and look at what air courts will be relevant for that. If you're not reporting IFRS already, if you're still on Nigerian GAAP or one form of, or even on IAS 39, 32 and 39, then you need to think about, the incurred loss model, right? And so there's a trigger also. So in terms of impairment, you also need to consider that would that be an impairment trigger based on what your policies have been. It's interesting to note, though, that in some jurisdictions in Europe, I think probably in the States also, the government has intervened, right? Working with regulators to provide some form of, I wouldn't say waiver, but, just helping the system. So to prevent shocks into the system, to give that kind of leeway to defer some of this. So there's been regulatory impact from both the regulator working with government to see how they can defer those losses, especially for banks and non-bank financial organizations that had a lot of mortgage. So if you think about COVID, people lost their jobs, right? And that's a risk asset. So that's a financial asset. Remember what Biola taught us. You could have your financial asset, under IFRS 9, it's no longer just HALF, right? Held to maturity, available for sales, loan and receivables, and financial asset at fair value. Now you have just 3, right? So it's either fair value to profit or loss amortized at amortized cost, right? Or fair value to OCI. However, because they've lost their jobs, if you think about US and UK, what it meant is that they could not pay their mortgages. And because they could not service the mortgages, the banks also were held to ransom. So you find that in some cases, government provided, you see what's happening in the US, there's a lot of money in circulation, providing money to people or talking to the banks themselves to say, you know what, give like a moratorium, right? Just hold this period and don't let that fall due. I don't think that has happened in Nigeria, but that's interesting. It's good to see CBN coming out with this pronouncement. You never can tell before your financial year end to see what the regulator will go. So again, it depends on what the regulator is saying, what the government is trying to do to avert this. But clearly, either you're reporting on IFRS 9 already, or you're still on IAS 32 or 39 based on not having moved to IFRS. There is either a trigger or you need to consider that in terms of your expected credit loss model to see where it will fall, either in stage 2 or stage 3. I don't know if I've answered that, but Biola, feel free to jump on that.
Thank you, Joseph. I think that was a good one. Let me go to the next question. How do you organize the training for the banks? Well, if you are interested in the training, you want to reach out to us, you can, I'm going to put forward just 1 minute. I'll put forward my email and contact now, so that as many people that may want to reach out to me, you can reach out to me directly. Just 1 minute, just trying to put that. And please, if you have not completed the poll, please kindly do that for all. We'll appreciate that. I will end the poll shortly now. So if you have not done that, please kindly do that. We still have about 10 people that have not completed the poll, but we'll appreciate if everybody can do that. Okay. I believe you all can see my screen. So this is my name, my email. So you can drop an email directly with me to continue the conversation. If you have people that have made that you like to have this training on a bigger scale, so we can take the conversation off this platform. I haven't classified, Joseph, I think you can also, I'd like you to assist with this question. I haven't classified a loan as non-performing. How should the interest be recognized in IFRS? So if we go back to this slide, let me go back to this slide. There's a slide I shared. Yes, this slide. So once the loan, you've classified it as non-performing, if it's in stage 3, the interest will have to be recognized based on the amortized cost, which is after deducting the impairment itself. You are going to arrive at a new amount, and you're going to calculate the new effective interest rate, and that is what you're going to use to recognize the interest income going forward. But if it's stage 2, you are still allowed to continue to recognize your interest income using the original effective interest of that instrument, because it's still at stage 2. Okay, for the training, are the loss parameter in this year model to be determined by each credit customer or the entire portfolio? So you typically determine your loss parameter along a portfolio or a segmentation. You don't want, it's difficult to work all of the parameters per individual load customer. Rather, you create a segmentation, which can be by credit assessment, it can be by location, it can be by sector. That's one of the first basic things you need to do when you want to implement IFRS 9. Doing your portfolio analysis to categorize or segment the portfolio into different buckets. But you will struggle to be able to do it on an individual basis. Last question, when calculating LGD, do we include expected interest derivative from the credits? What total amount that you can recover? If you think you will recover any amount from that, you can also include it. But that is if you think and you can ascertain that you will be able to recover any amount. Okay, I think we've answered all the questions. I don't know if anybody other person has questions for us. It seems like no other questions. No other questions for us. So, I mean, we'll bring the webinar to a close shortly, but I want to tell us, please, if you need any assistance, you can always reach out to us. And okay, somebody asked a question. There was one question I did not answer. Somebody asked a question about what it will cost the auditor. Let me go back. What is the estimated support cost? A certain auditor need to factor this as part of the fee. What I will always advise the auditor is, no, you don't need to bear this cost directly. Why not get your client to comply? Because just like the point Joseph made, if we don't get the foundation right, if we just use a shortcut, you continue to use that shortcut year on year. The right thing is to get the foundation right, which is let the whole internal system and environment comply, so that going forward on an annual basis, your client is able to produce an IFRS compliance financial statement. So that's really the right thing to do. And for as auditor, I will advise that you should get your client to sign up and come along with your client into that exercise. So you also gain as your client is also learning. There will be knowledge sharing along with the client. Okay, so I think that's the last questions. I want to thank everybody that have joined this webinar today. Joseph, a very big appreciation from the OPMS team to you for sparing your time and keeping awake to do this. We do not take it for granted. Thank you very much. And Chris, thank you for coming in. And every other person that have joined, the PML team that have supported this in the background, thank you guys. And we will continue to reach out to as many of you that have indicated that you have a need on how we can support you to comply with an IFRS and IFRS 9. So do have a good evening, a good night rest, a good morning, a good afternoon, depending on where you are. So thank you very much. And bye for now.
Bye.
Bye.
Bye.